Welcome to Your Money Momentum, a podcast delivering information on personal financial planning, investing, and wealth management. Hosted by global wealth advisors Tom Kennedy and Kevin M. Curley II, this show will feature market discussions, strategy, and practical advice aimed at building momentum with your money. Learn more and subscribe today at gwadvisors.net/podcast. And now, here are certified financial planner professionals, Tom and Kevin.
All right, everyone. You are listening to Your Money Momentum podcast. My name is Tom Kennedy, and I have Kevin Curley here. Kevin, what's going on?
Not much in Dallas, Tom. How is the refugee life in Houston? I see that you've made it to, are you in San Antonio or are you still in Houston?
I'm still in Houston. No power, no water. It's brutal.
Second time this summer that you're doing one with, we'll say a struggle situation of no power, no water. So
sleeping on friends'
third world
couches.
city you live in down there.
Yeah, it's brutal, but fingers crossed.
Yeah, my city of birth is struggling down there. So, all right, Tom. Well, today we're going to be talking structured products, and very exciting. We have the return of Nostra-Thomas. So why don't we just jump right in to structured products? First of all, just quickly, basic definition, what is a structured product?
So we talk a lot about, and we've done a podcast on alternatives in the past, and I think we briefly touched on them, but it's, the alternatives category is very broad. You can throw in anything from REITs to, private traded real estate to hedge funds, et cetera. But one of those categories is what's called a structured product or a structured note. And essentially, and you see this a lot now in insurance policies as some of the investment options, but, 10, 15 years ago, to truly get into a structured product, you had to have at least 10, 15 million and go directly to one of these investment banks that create these products. And essentially, there's different iterations of it, but in its simplest form, if you take like the S&P 500, you take an index and you say, hey, over the next, call it 2 years, I'm going to invest in this index and I have an upside cap, call it 20%. So if the market's up 30, you're up 20. If the market's up 10, you're up 10. But you have what's called a buffer. You have a downside protection. And if you have a 20% cap, maybe your downside buffer is 10. And that cap might be a little high. I'm just throwing out some random numbers. So if you have a 10% buffer after the 2-year period, if the S&P is down 5, you're flat. If the S&P is down 10, you're flat. If the S&P is down 15, you're down 5. So they protect you in the first 10%. And there's so many different flavors and iterations of these structured notes. You can do them on individual stocks. You can do them on multiple different indices and do the worst of.
Let's before we jump all into the details and all that, let's kind of keep it a high level first. So the first part is it's a debt instrument issued by one of these investment banks. So it could be JP Morgan, Goldman Sachs, all these different banks are issuing these structured notes. Why do they issue them?
Well, these investment banks, they make a lot of money on these structured notes. They're investing in debt, as you mentioned. It's usually tied to some sort of bond, and they tie that duration of that note to the duration or maturity of that bond. And then there's options that they do. They go into the option market and they use derivatives to write calls and puts and short these different strategies to help generate income. And it can get very complex on how they do them. But these investment banks, this is one of their profit streams. They make a good amount of money, and they realize that opening these structured notes up to the everyday investor, they can gather more assets by doing that.
So if we start kind of at the basics, and I was interested in buying a structured product, what's like the most basic plain vanilla? Would that be like a market link CD or a different type of structured note?
Yeah, there's a couple different kinds. The first one is what's called fully principal protected, meaning that your principal is not at risk. subject to issuer risk. Obviously, it's like investing in anything else. If the issuer issuing it goes bankrupt, well, there's your credit risk. But you have what's called a market link CD, which acts and feels a lot like a CD. You know, there's could be a 1 year, 2 year duration or hold on it like you would have in a traditional CD. Instead of getting an interest rate, it's going to be tied to an index like the S&P 500. So going back to that example, you might have a cap on that, and you're going to have 100% of that principal protected, but the cap's not going to be very great. It might be 7 or 8% over 2 years. It might do better than a CD, but you're not going to get the interest that a CD would pay, but you're fully protected, meaning if the market's down, you get your money back.
So when you say principal protected, does that mean FDIC insurance?
It doesn't mean FDIC insurance. So that's the biggest drawback with a structured note or a market link CD versus an actual CD. Is the CD is FDIC insured, where a market link CD is an investment. So
Okay.
you get
So
your money
this is
back.
basically a different version of a CD. Instead of prevailing interest rates, I just get whatever the S&P 500 or another indices performance is, subject to a cap. But in theory, that cap's going to be a lot higher than prevailing interest rates, and that's why I would do it.
Exactly. So if you do a 2-year, market link CD, you want that cap to be probably north of 10% because you can get CDs now for 5%. So
Mhm.
5% over 2 years is 10. Now, as rates go down, CDs will go down. That's one of the drawbacks of CDs is once they mature, you have to reinvest, and interest rates could be a lot lower. But there's opportunity cost at hand too, meaning if the market does not perform and it's actually down, yeah, you don't lose money because you get your principal back. But if you were in a CD, you were collecting that 5% interest
Mhm.
each year or whatever it was.
Okay. Well, that makes a lot of sense. Who is this type of product, specifically the market link CD? Like, what's the profile of investor that this makes sense for, and who does not make sense for? And along those lines, should it be in an IRA or should this be in a taxable account?
IRA is always preferred, just because you don't have to pay capital gains tax or any tax until you take that money out. I would say risk profile, it's very similar to a CD client. A CD client is very, very conservative. They don't want their money tied to the market. So risk profile wise, you're not going to lose money on these market link CDs again, unless the issuer goes bankrupt. However, what these strategies are not for, a lot of those CD clients are doing those CDs for income. So if you're looking for income, a market link CD is probably not the route, because this is more for, hey, I'm conservative, but I do want exposure to the market in case the market continues to go up. And although there's a cap, I can take advantage of that versus a CD investor, also conservative, but may need that 5.5% income each year to live off of.
Okay, so that seems like kind of the basics, the simple one, easy to understand. There's some tax things you probably want to check with your CPA, make sure you have that right. Because my traditional interest from a CD is ordinary income, and maybe that structured product gives off ordinary income, maybe capital gains, depending on how the returns are. What another example? I've heard of these auto callable notes. There's participation notes. What's kind of the second, if we're going up the chain ladder and going, okay, market link CDs, that's kind of level one. What's level two and level three look like? And when do I use those?
Yeah, so I would say level 2 is when you have some of your principal at risk, meaning you don't risk all of it. You have some kind of downside buffer, but you still can lose money based on the market if it goes through that buffer amount. And there's two different categories. It's income driven or growth driven, or sometimes there's a hybrid and combination of the two. But for clients that need income, you can invest in these structured notes that aren't geared towards growth or geared towards generating a monthly income stream. And these monthly income streams tend to be higher than your traditional bond or CD or money market type fund. They participate in the equity market, but they're going to be able to generate a much higher income based on where the indices are. So they have these CDs where every month they pay income, and as long as the market doesn't go below a certain point, usually 30%, you get paid that income. If it drops below 30% that given month, you just skip that month for that income. And once it gets back up that above that buffer amount, then you start receiving the income. So it's kind of get the best of both worlds. And at the end of the deal, whether it's a 1-year deal, 2-year, they go out to 5 years. There's also protection against the principal. So if it's a 5-year deal and the market were to be down, you have a buffer, call it 15, 20, maybe even 30%. So as long as it's not down more than 30% from point to point from when you started over that 5-year time period, which has never happened, you're going to get your principal back.
So Tom,
And
let's
along the way,
say
you
I hear
accumulate
you
all that income.
talking and I go, I want to go buy these. I'm going to go to my broker dealer or my brokerage account and type in an ETF, and I'm just going to pull up a structured product and buy it, right? Pretty simple. Just buy it right off the shelf.
Yeah, so you mentioned ETF. So there's an ETF version. There's different vehicles you can buy these structured notes in. They ETFs have become very, very popular because they're fully liquid. So they work very similar. You can go in and out of them just like any other ETF, but the terms aren't as great because you have that liquidity, and anyone can buy that in a brokerage account or a fee-based account. Um, the other the other vehicle is doing the actual customized structured note through the investment bank, whether it's JP Morgan, Barclays, HSBC. There's a ton of them that offer these structured notes, and that's when you have the terms. You can always get out of these notes, but you're just subject to whatever the market is at that time. But there's a lot that goes into how we price them out, because that's when we can start to negotiate with these investment banks on better deals, better terms, bigger buffers, higher caps, etc.
All right. Any extra risk that we should be aware of if we're going to add these to the portfolio? What's the really big benefit? I know we've talked about alternatives before of having a sleeve in there. It can help with kind of the advanced metrics when it comes to portfolio performance, risk adjusted returns, that type of thing. Is this fall into that bucket as just like a different thing than stocks and bonds, or how does this fit in overall portfolio asset allocation?
It does. We use these as a pure hedge. You're not, we use kind of that version 2 where you have some principal at risk, and we just did some that had fully principal protected because we think it made sense. But you're using it as a hedge. It's gonna act a lot like the equity markets, because you're going to be tied to the indice. But if the market's down a certain percent, you're at least protected for X amount percent. So it keeps you invested in the market. It hedges the portfolio really nicely. It brings down the correlation, so everything's not moving in the same direction, and it just provides some protection. And in return, you're going to give a little upside return. So you say you did a 2-year deal where you had the S&P, you had a cap of 15% and a downside of 10. Well, you're making a bet over the next 2 years that the S&P is going to fall anywhere from up 15 to down 10. Anything outside of those two, you lose money on. But then you got to look at the rest of your account, and you're going to be invested in other stocks and bonds that are also going to be down. So this is a great way to just hedge the portfolio and really just smooth out the volatility.
Yeah, so something different that hopefully also has a positive return, and that diversification can be pretty valuable in the long run.
Yep. It just
Any,
allows you to get off the sidelines. If you're very, very conservative, but you hate seeing the market continue to go up, you just don't want to take all the risk. This is kind of a good in between.
all right, great. Well, let's go see what Nostra-Thomas thinks about all this.
And now, we ask our soothsayer to gaze into his crystal ball. Let's hear from the alchemist himself, Nostra-Thomas.
All right, let's do it.
All right, so the return of Nostra-Thomas, it's been quite a while. I don't know if it's been months or years, but I feel like he's been hiding for a while. So hopefully he can dust off his crystal ball and help us out here. So Richard Bernstein recently wrote that U.S. stocks may be headed for a lost decade due to higher valuations. Some areas, especially those associated with the AI trade, are trading at 14 times their projected earnings, and the S&P 500 is pretty high at a almost 23 PE ratio. So Nostra-Thomas, are U.S. stocks at risk at another lost decade like 2000 to 2010?
Yeah, so the answer is no. But let's take a quick recap of what 2000 and 2010 looked like. You had two major crashes. You had the tech bubble in 2001, and then you had the GFC in 2008. So if you invested in the S&P 500 in January 1st, 2000, and looked at your account January 1st, 2010, you had almost a 0% rate of return, because you had, a 40 and 45%, 240 to 45% declines during that decade. I don't think we're going to be in a lost decade. I think that
Think.
was
We want to look in your crystal ball and tell us the result. We don't want to think.
well, my crystal ball has been a little hazy last couple years. Listen, there's valuations are extremely high right now. There's no question about that. It's been fueled by AI. You have PE ratios at all-time highs, especially on the tech side. So I think you're going to naturally get a reset. But this reminds me a lot of 2020. You had so much, and you look at all the other past bubbles, you had a lot of stimulus that was dumped into the market. I mean, we had $7 trillion during COVID that was pumped into the market, $7 trillion, which is unheard of. Our M2 money supply, which is all the cash available in money market CDs and savings accounts, was at $16 trillion. And overnight we went to 23. So you have all this money in the market and it's got to go somewhere. And last year you had 7 trillion of that go into money market funds. And what you're seeing right now reminds you a lot of 2020. You have all this money coming off the sidelines and chasing stocks. So I think I wouldn't call it a bubble, but there's definitely some sectors that are elevated because of that money going into the market. So I think you're going to get a reset. I'm not calling for a massive crash, but to get another lost decade, you would have to see 2 pretty big crashes. And I don't foresee that happening.
All right. So the next thing comes from just across the Atlantic. England's elections ended 14 years of Conservative Party rule and put the Labour back in the Prime Minister's chair. Meanwhile, there's been major changes from groups that ran Mexico for a long time being unseated, and France just had an election on Sunday. It's going to shake up a lot of what they have going on. I know it's dangerous, but what does Nostra-Thomas think is crystal ball showing for the U.S. election?
I think we put way, way, way too much emphasis with the election in the U.S. stock market. And you look at the charts. And
oh, no, I don't mean about the stock market. I mean, what's the result? We want to know the crystal ball, who wins.
The result is clear. After that debate and after the poll
the candidates are clear. How can the result be clear?
I think, well, that's why it's clear. I would find it very hard to believe that the Democrats take the White House. I think the GOP, I think they pick up 2 or 3 seats on the Senate, keep control of the House, and I think it's going to be a clean sweep across the board. So I think we will see Donald J. Trump sitting in the White House November 6th or 4th? And I think you will see a knee-jerk reaction up on the stock market, and I think that'll be a good time to take some gains and to rebalance. And if Biden does take office, which I highly doubt, but if he does, you probably will see a sell-off, and it'll be a good opportunity to buy.
Great. Well, that was a very definitive answer. So we're over a year now since the last banking crisis that took down Silicon Valley Bank and First Republic, among others. What does Nostra-Thomas see in his crystal ball about the next crisis or the next black swan event? Typically unpredictable, but you have that power. So what's it going to be?
I do have that power, and I will tell you the one thing that keeps me up at night is the sovereign debt crisis that we have in our country. $33 trillion and counting. You look at the 2024 budget, we had projected a $1.5 trillion deficit. It looks like that's going to be closer to 2 by the end of the year. That is not good. That is bad. And we've talked about this before. You look at just the debt interest, just the interest the government has to finance our debt is going to be at $1 trillion. That's more than our defense spending. The challenge is going to come is what our government, you're going to see a Netflix documentary or books written about this in the years to come, but how reckless the government was by not refinancing some of our debt when we had all-time low interest rates. As this debt matures, they're going to have to issue new debt at much higher rates. Even someone who has no idea about finances, everyone knows that when interest rates are low, what do? You refinance your house. And a lot of people did that. Why didn't our own government refinance our debt? So I don't even know. This could be a catastrophe. The next step is a downgrade. If we get downgraded, well, what happens to interest rates? Interest rates will go up because you have to be compensated to buy lower sovereign graded debt. I mean, you saw what happened.
Treasury's actually rallied on the last downgrade, but in theory, you are correct. That's how the math works.
In theory, we're writing IOUs and
from AAA to AA and rally yields rally. You're like, okay, all right, cool.
So that could be the next. And I don't even think it's a black swan. I think it's clear as day out there that we have a massive, massive issue. But I don't know what that looks like because we don't have, Germany to bail us out like they did with the other EU countries. So it could get pretty ugly. However, there's a way out. It's called growth.
That's the more fun, easy way out. There's other ways out too. But all right, so we're gonna move on to something a little bit about volatility. I'm gonna kind of accidentally call somebody out, but they wrote the article in a public paper, so they can deal with it. In February 2023, the CIO of Guggenheim Partners, Ann Walsh, said investors should not expect relief from volatility. Volatility was here to stay. Volatility wasn't going anywhere. Since then, the VIX has fallen 40% and has been calm, and she basically top ticked the volatility regime that was happening back then. Now I'm going to give Nostra-Thomas an opportunity to do the opposite and say, these low volatility times that we're having right now, we're at 12 or at a 13, we're at a very low, it's very calm. Market just kind of goes up a little bit every day, very quietly. Are you willing to call a bottom in the VIX like Ann accidentally top ticked it, or volatility continuing on? What do you see in that crystal ball?
I don't know if Ann Walsh and Meredith Whitney are having lunch together every day, but if there's an ETF that we could short their opinions, we'd all make a lot of money. That might have been the dumbest call I've ever heard, because the VIX is what they call the fear gauge. It just goes up and down based on the volatility in the market. And a good way to look at the VIX is you look at what the VIX is divided by 16, and that's going to be your expected daily volatility or percentage swings in the S&P. So for instance, the VIX right now is what, 12? So 12 divided by 16 is 0.75%. You're going to see on average 0.75% swings in the S&P. If the VIX was at 16, you're going to see 1% swings. When it gets up to 30, that's a 2% swing. So I think volatility is going to remain low throughout the year, because I don't think you're going to have a lot of movement in the market. I don't foresee some massive sell-off. And if there is, the VIX will shoot up. It's not like it's a stock and there's earnings and you can predict it. It moves with the market, and it's a fear gauge. So again, as people get more pessimistic and things start to sell off, you'll see the VIX start to creep up. But being under 20 is pretty low, and we've been there. And by the way, you look at the S&P 500 since the Silicon Valley banking crisis, we haven't had a 2% swing on the S&P, which is going well over a year. So you're seeing very, very low volatility in this market, which is a good thing for the
It's been a few months since we've seen a 1% swing too. So
it has.
We'll see how if we can get down to 0.5%, no more. Keep it really, really low vol. All right, so the final one, Howard Marks, who we like to reference, he's a pretty well-known figure. He's written about the importance of taking the temperature of the trading herd. So what does Wall Street think? What is the consensus? What's retail think? Just kind of getting an idea of it. So I was curious if Nostra-Thomas has a thermometer and can take the temperature of the current trading herd.
It is hot. It is hot right now. And something that I look at is the bull bear spread. There's a lot of different indicators out there, but it just shows, hey, is the average investor optimistic or pessimistic? They look at it from an institutional level. They look at it from a financial advisor level. And optimism is extremely high right now. You have this kind of FOMO taking place in the market with, everyone's darling stocks like NVIDIA that have just been on a massive run in anything AI related. So I think the temperature is extremely hot, which unfortunately doesn't usually end well, and it'll end with some kind of resetting. But we've seen these periods run for quite some time. Again, this reminds me a lot of 2020, not as extreme, but you could see this run throughout the rest of the year. But there's going to be a resetting, and like what Warren Buffett says, sell when things are high and buy when they're low, and things are starting to get up there, especially in certain sectors like tech.
All right. Well, thank you, Nostra-Thomas. In a few months, we'll see you again maybe, and get some more predictions maybe post-election.
Nostra-Thomas only comes out when he's right. So
broken clock, right?
Broken clock. All right.
All right. Well, thanks, Tom, and thanks, Nostra-Thomas. We'll see you next time.
All right. Thanks, Kevin.
You've been listening to Your Money Momentum, brought to you by Global Wealth Advisors. To learn more about GWA and its talented roster of financial professionals, head on over to gwadvisors.net. Thanks, and we'll see you next time on Your Money Momentum. All indices are unmanaged, and investors cannot invest directly into an index. Certain sections of this commentary contain forward-looking statements that are based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties, which are difficult to predict. Past performance is not indicative of future results. Diversification does not assure profit or protect against loss in declining markets.